We frequently hear that Franco-Nevada and the other major gold and silver royalty and streaming companies trade at 2 times NAV. But today, I'm going to show you why they're wrong. The gold analysts are wrong. And it's not that they trade at 2 times NAV, it's that the analysts are calculating the NAV wrong. So how do they do it? I'm going to show you a pretty quick and simple breakdown based on the idea that a company only has one royalty. So this is going to be a little demonstration based on one single royalty. Let's just pretend it's the entire company. Okay, so they have a royalty and their portion, let's just call this Franco-Nevada. Franco-Nevada's portion of this gold royalty nets them 50,000 ounces of gold a year according to the mine operator's mine plan. So the next 10 years, they're supposed to receive 50,000 ounces a year based on the current mine plan and the current output. So assuming gold is at $2,000 an ounce, their 50,000 ounces of gold is going to be worth $100 million in year one. That's a terrible M. Okay, so $100 million in year one. However, then what the analysts do for year two, they're like, well, money in the future isn't as valuable as money today, which is perfectly reasonable. So then they're like, okay, so we're going to value year two at 90 million, year three at 80 million. Now, this is a very simplistic version of this, and this isn't exactly how it works, but it gives you a pretty good idea of how it works without going into too much detail. And then year four, we're at 70, year five, that same 50,000 ounces is at 60 million. And what they're doing here, they're assuming that the production is never going to grow, that it's just going to stay at 50,000 ounces a year because that's what the miner says their plan is, and that's what their current mill is operating at. And when they go to calculate how much each ounce is worth, they use the current price or the forward strip in the futures contracts. So year six, 50 million, year seven, 40 million, and so on down the line. And then basically anything after year 10 is almost considered valueless, according to analysts. Now, Franco-Nevada, for example, they have gold royalties on copper mines that have 40, 50, 60-year mine lives. And these mine lives are going to expand as these operators do more drilling. So they have gold royalties on mines that are going to be lasting 100 years. They're still going to be producing 100 years from now. And they get virtually no value by analysts after year 10. So the analysts take these numbers. They're like, okay, this is the net present value, the NPV right here per year. We add this up, 100 plus 10 times 5, that's $550 million. That's the net present value of this royalty, according to these analysts. And then let's say the market cap is 1.1 billion, exactly double that. So the market cap 1.1 billion. And they say, okay, they're trading at 2 times NAV because we calculated the NAV and their market cap is double that. But that is not the right way to value these royalty companies. This is very flawed logic here. Now, this is a perfectly acceptable way to value your average gold miner, like Barrick Gold. However, not with the royalty business model, the royalty and streaming business model. This is a terrible way to value it. Why? Well, two main reasons. One is that the metal prices, whatever you have a royalty on, in the long run, they tend to go up over time. So keeping the assumption at $2,000 an ounce for every year in the future is not correct, because 10 years from now, it's probably going to be significantly higher than $2,000 an ounce, because over time it just goes up and up and up. Like the dollar becomes less valuable, there's more inflation, and the cost of everything is rising, and so do the price of the metals. But their assumptions say that gold is going to stay at whatever it's at today. So that's one major flaw in how they value it. And the second major flaw is they do nothing to accommodate for the fact, well, it's almost always a fact, that the mine operator is going to expand that production. They're going to expand that mill. And let's say they're currently running 10 million tons through it. Well, maybe on year 3, they're like, hey, we're going to expand our mill and we're going to double production. So we're going to take it from 10 million tons of ore that we're processing to 20 million tons of ore that we're processing. So you know what happens? So let's say they plan that on year 3. It takes a year to build. And then on year 4, they're now running twice as much material through the mill. And our royalty company didn't have to spend any money to do that. And instead of getting 50,000 ounces a year, they're now getting 100,000 ounces a year. So by year 5, the company is getting 100,000 ounces a year instead of 50,000 ounces a year that this model predicted, plus the gold price is probably higher than it is today, or whatever metal you have a royalty on. So that is why they calculate the NAV wrong. So it's not that Franco-Nevada trades at 2 times NAV. It's that all the analysts are calculating it wrong because they're not taking into account mine expansion, and they're not taking into account how the prices of the metals tend to increase over time. Now, this especially applies to the royalty and streaming companies that have royalties or streams on very long live mines. Because when you have a mine, when you're operating a mine that has, let's say, 50 years of mine life, producing anything 25 years from now, the market gives you no value for that. Because they're like, well, based on like the discounted cash flows, like it has no value 25 years from now. So what they do is they try to expand their mines and they bring that production forward. So instead of running 10 million tons of ore through it, they increase it to 20 million. So now their 40-year mine life becomes a 20-year mine life, and they're producing twice as much. And then the market gives them value for that. However, the gold stock analysts, when evaluating the gold royalty companies, they just assume that production is always going to stay the same. And on these super long life mines, that is just not the case. We don't know when exactly they're going to expand, but like there is lots of history showing that these operators that are operating these long lives mines, they always expand production over time. So that's how analysts get it wrong. Hope you got some value out of this. Please subscribe to the channel and click that like button if you got some value out of this video, because I release a new video on mining stocks and gold and silver and metals almost every single day. And I'll see you in the next one.